Hi friends, welcome to our Tax TV channel. Remote workers can create multiple taxation issues for businesses. A growing number of companies have told employees they can live and work anywhere. This can pose a world of new tax obligations. Some employees went back to the office after government stay-at-home mandates were lifted, but others may never go back. A growing number of companies have told employees they can live and work anywhere. That opens up a world of possibilities. It will likely create a world of new tax obligations too. Permanent international moves are much more complex, so they won't be able to support those this year. Even having employees in different countries temporarily can create tax complexity. Most companies don't do this because of the mountain of complexities with taxes, payroll, and time zone availability.
Working remotely within the United States can establish Nexus. Nexus is a connection that enables a taxing authority to impose a tax obligation on an individual or business entity. As a general rule, the connection must be substantial. Unfortunately, every taxing authority defines substantial differently. This brings us back to setting up shop in another country.
Working remotely in other countries can establish nexus and trigger tax obligations. Transfer pricing may also come into play. A transfer price is a price applied by a company to goods or services transferred within the company, i.e., an intercompany transaction. In the case of remote work, an employee based in one country may create a permanent establishment, PA, for their employer in another country. In this case, the local tax authorities may be entitled to levy taxes on the PA, in addition to any payroll taxes. Tax authorities will then use transfer pricing methods to determine the level of profit, or taxable income, of the PE. Typically, the profit of the PA will be based on the nature of the employee's work, for example, marketing, research and development, etc.
As companies of all sizes expand globally, they need to maintain transfer pricing compliance concerning their international activity. However, businesses may use transfer pricing to reduce their overall tax burden. For example, a company may opt to pay more for goods or services provided by divisions located in a high-tax country, rather than paying less for goods or services provided by divisions located in a low-tax country, because that could reduce its overall profits and therefore the tax on profits. Tax authorities the world over have intensified their focus on transfer pricing. They're less likely to take an interest when intercompany pricing matches pricing for unrelated companies, and when pricing for international intercompany transactions matches pricing for domestic intercompany transactions. If there's activity, usually associated with sales of a product or service, in a country because an employee is working remotely from there, the local taxing authority will want to know where the work is happening, for example, a home or office. We work desk, and whether the employee's presence creates APE. If it does create APA, the tax authority will want to know how much profit should be attributed to the PE. For transfer pricing purposes, the employer may need to allocate profit to a remote employee's work. Typically, the profit is based on the cost plus method, with an arm's length markup 4%, 7%, etc. To determine and support the proper rate, it may be necessary to prepare a transfer pricing report with comparable companies. That's what tax authorities will do to ensure transfer pricing is properly calculated.
You can't hide from the tax authorities. In fact, information is often shared automatically. Governments worldwide are working to increase automatic data sharing and increase tax pricing, so it will no longer be necessary to make a request for information. One way to manage all the exposure this creates is to ensure every country gets the same story. Be consistent. Be transparent. Document everything. Is one remote employee enough to give its employer a substantial presence? It depends. If the employer is a small company with only 10 employees, one employee may create substance. One employee out of 50,000 employees may not. Yet countries may be more likely to take an interest in employees of larger companies because they're likely to have more profits, and taxing a small percentage of a big profit can bring in enough tax revenue to make it worthwhile for the country. Another factor is the level of the responsibility of the employee. The higher their rank, the more responsibilities can be translated to higher attributable profits.
A word on VAT. Remote working can also create value-added tax (VAT) issues for employers and employees, especially if a remotely working employee gives its employer a fixed establishment in another country. In this case, services provided by a remote employee would likely be subject to VAT in that country, requiring the employer to register, collect, and remit VAT. You don't have to navigate remote work tax complexity alone. Most small and mid-sized companies won't be able to put that many people to solving this problem. Automation can help small and mid-sized companies, and accountants working with these businesses, manage tax exposure and risk.